Okay, PwC put out a really nice report through a survey. They have a piece out for every single kind of asset class in commercial real estate. We're just going to focus on the multifamily piece. But if you are subscribed to the Gray Capital newsletter, the Gray Report newsletter that goes out every week, every Thursday at 8:30 a.m., there's a link like in last week's newsletter to every single section for every asset class. If you want to keep getting sent really insightful reports like this, sign up for the Gray Report newsletter at graycapitalllc.com. Affordability shapes multifamily trends is the headline. Deliveries are waning alongside sharply decelerating starts while demand moderates amid slower job growth and reduced immigration. The growing affordability gap is driving migration to smaller cities and prompting policymakers at all levels to devise strategies to deliver more housing. And multifamily remains a favorite asset class for investors, but deal flow is limited by questions about whether its perceived stability justifies current low acquisition yields. That last point, the last bullet point that I read, really resonated with me more than anything. The deal flow is limited by questions about whether its perceived stability, as in multifamily, perceived solid asset class, is always going to be needed. It makes sense. But is that enough to justify some of these low acquisition yields? I think it's a really good question, and this report is kind of chock full of a lot of anecdotes from industry professionals. What was kind of your thought, Griffin, as when you were going through this report, and any of your own kind of takeaways before we go into any of the graphs and some of the quotes?
I think there's two paragraphs in the middle of the screen currently about how everybody thought 2025 would be a year of recovery. It seems like now that recovery is moving into 2026. And then that paragraph just below that says that not that the multifamily outlook is bearish, but the long-term growth and stability of multifamily, I think, is speaking for itself. If you take a look, I think a few weeks ago we talked about year over year, maybe a quarter over quarter NOI growth across all real asset classes and sectors, and multifamily was in there as quite reliable, quite steady. And while we spoke about deceleration at the front end of this podcast, I think that's just going to be the storyline in 2026. And it's not a deceleration from 2025, but just I think relative historical averages. But with that being said, there are pockets, as real estate is hyper-local, and specifically if we get talking about regions of the United States, the Midwest will continually see this steady growth that we've predicted in our 2026 multifamily forecast, that I think we can get quite excited about. While other regions of the United States are seeing negative rent growth or a more severe deceleration, the steadiness of the Midwest is something that I think gets some good attention, not only in this PwC article, but also the next DRD article that we're going to take a look at.
Well, what's challenging, though, is we can look and say, hey, supply's coming down. Midwest is doing pretty good. But still, a lot of the deals that we underwrite, and you hear, Addison and Jay and I talking, we look at a lot of deals, and, the price that sellers are asking, produces returns that are just not exciting. And so we can be bullish on the fundamentals, and like supply's coming down, and there's a need for housing, and more people. There's more renters than there's ever been because the average new home buyer now is over 40 years old, and that means all those other folks are still going to continue to rent. But at the end of the day, when we underwrite a deal and the cash flow is like 3%, 4%, even 5%, and the IRR is sub 15, we can talk about how we can point to some fundamentals that look exciting, but the numbers are the numbers. And so it requires us to then use our gut to say well, I feel that the numbers are going to turn around in a couple of years. But there's no actual data that's pointing to rent is going to start recovering and start growing in X year.
Yeah.
Just looking
April
at
27. It's nobody's making that call, and if they do, they're putting themselves on a very fragile limb.
No one wants to make the call. You're right. And because people have made the call, not even for really accelerated rent growth, but again, just 2025 as an example. 2025, and I'm pretty sure 2024 as well. It was going to be like a return to normal. It's going to be, everyone was saying it's going to be 3% rent growth. And you can go back to previous Gray Report episodes where we basically just said it's like that just means that no one knows and everyone's just putting what the long-term average is. And so like no one's going to, there's like safety in numbers if just like going on the long-term average, but everybody was wrong. And so it's like, well, if we're not growing now, when will that growth occur? And so like if you're talking to an investor, I mean, how do you, well, what's your answer?
Right. I think in my conversations and just being local to Indianapolis in a market that we just closed an asset, just acquired an asset in, driving around town, you can see the demand, and it's indicative in the continued development of hospitals, just surgical centers, retail storefronts, restaurants going in, multifamily communities being built, neighborhoods being built, single family residences popping up. So when you're discussing, forward projected rent growth within our underwriting model, while some of the data may not say that that's going to be, specifically the case, I think I can speak from a boots on the ground or an anecdotal, perspective, and to really try my best to depict the immense amount of, growth that's occurring here in Indianapolis and or the markets that we are operating in as we go tour properties. I think once you get into a market and can actually tangibly see and feel, the population growth, the job growth, and be able to articulate that to investors when they do see, hey, we're going to have some deceleration in rent growth over the next few years, just based off some of the data. If it's a long-term hold, and which our assets typically are, that's typically our business strategy is 5 to 10 year holds. There's some promise in seeing some growth, just through that steady demand in the markets we're operating in.
Yeah, but also doing this this last forecast report and seeing a lot of the work that John was doing on his model and learning more about the methodology also, I think was insightful in that we really don't have the tools to really look around too many corners, just because there's no visibility, and we only have like short-term data, and these trends are being built off of like very hyper recent data, and the hyper recent data is relatively slow growth and dealing with all these concessions, dealing with all this supply, and so it's extrapolating that trend, and it's not necessarily going to grab that. All right, well, all of these pieces are going to fall into place, and supply will have all been delivered by this time, and therefore in 2 years or 3 years we're going to start seeing this this pop. That's just like kind of not how the models work. Because even if it's the supply is one input, it's not the only variable. There's a lot of other variables. One of those is the trend of recent rent growth, and so if the trend of recent rent growth is relatively low, it's going to be harder to kind of punch out above that, and so it's we want to be data dependent. But real estate for the longest time has always used the data, but it has more traditionally used that kind of that intuition that you just described of driving around a market and seeing the things that the reports aren't necessarily picking up, and understanding the population growth and the job growth.
Yeah,
but also the fact that there's somewhat limited supply. Because I'd say to counter that, drive around Austin. There's an energy around Austin. There's people moving.
Is there I mean, there's obviously such thing as too much growth at one given moment. And I think here in the Midwest, specifically in Indianapolis, it depends on if you go north side, east side, west. Yeah. It doesn't matter where you go, you're seeing some growth. But specifically just operating on the north side in my daily life, there's a lot of growth occurring. Yeah. You're also seeing what I think is some downward pressure on rents, just because there's a highly competitive environment being created by all of this influx in supply. So as we went and toured flats on the south side down in Greenwood, that was one of the greatest things we could have ever done in our capital raise, was to take prospective investors down to flats, let them walk around the property, see how nice and new it was, but also to let them see all of the surrounding growth at that site, of which was hospitals, surgery centers, retail storefronts, with very little multifamily supply being delivered.
No, that's a good point. You can look at the growth, but what kind of growth? It's really qualitative, and you can have a ton of retail growth, everything you just said. But if you've got tons of apartments everywhere, also, it might not be as exciting as there's a ton of jobs coming in. But where are these people going to live? I see one new apartment building. It's 200 units, but there's going to be 5,000 jobs. Where are all those people going to live?
Right.
That's a really good point. All right, let's look at these graphs. I'm going to want to move to the second one, but I think it's actually a little more interesting than the first. These are buy, hold, and sell recommendations for apartments, breaking down kind of some of the sub asset classes of housing from senior to lower income, single family, student housing, moderate, high income. Not a lot is in the strong sell category. There are some interesting trends. Looks like senior housing is the kind of the standout in terms of the strongest buy signal of 23.6% of respondents saying, hey, this is a strong buy. That's compared to high income apartments, which is only at a 9.1% strong buy rating. 42% is on kind of just the buy rating for high income apartments. 37% is at a hold, with 10 are expressing, hey, you should probably sell those high income apartments. The senior housing is interesting. I mean, it makes sense because a lot of folks are retiring.
The gray wave.
Exactly. Yeah, the gray wave, the silver tsunami.
Yeah, there you go. Yeah,
Which is interesting because there's a lot of aging in place. People, a lot of seniors don't necessarily want to, or baby boomers, whatever the politically correct term is for older folks. They don't necessarily want to move out of those, 6-bedroom homes. They'd much rather just let the millennial generation just kind of stir around, tell their parents they need to move out, and not unlock that housing supply for other folks. Student housing is also interesting in terms, 11.8% folks saying, hey, you should buy some student housing. 56% just say buy. 27% are saying to hold the asset class itself. Any other standouts on this chart for you? I mean, basically, it's 50% of folks. It's buy or
hold.
Buy or hold.
It's a good time to have a healthy portfolio.
Yeah, and I think it reiterates. It's not. So this is, we were talking about before we press record, and kind of similar to like a buy, hold, sell rating for stock market. And it's a little bit different because it's not like people are saying, hey, you need to sell it because things are going to get worse. It's almost like sell it because it's not a good time to sell right now. You're going to be selling low, and just got to hold on for a little while longer before you get into an environment of where you can probably get that price that you're actually looking to get. Let's talk about pricing. On the survey, opinions of current apartment pricing. This isn't exactly, actually, this is, to me, this is surprising.
I would agree.
It's 70% of respondents say that high income apartments are fairly priced, with only 8.3% saying underpriced and 21% saying overpriced. Pretty much everyone is saying that all of these asset classes are somewhat fairly priced, with lower income apartments being the least fairly priced. 30% of folks are saying that they're overpriced. I think that makes the most sense because, when I see a 1960s built, kind of value add deal that's priced, the same cap rate as a 2025 or 2024 delivery, I start, it becomes a little suspicious.
I'm even just taking a look at the single family rental. With where interest rates currently are and where they have been, having a single family rental becomes quite challenging to produce any cash flow. So I'd be interested to know at what LTV, maybe this question was being asked around, just based off of leverage. Because with the leverage that we're typically targeting, I think you would be in the overpriced, department in high income apartments.
I'm a little shocked by this survey, to be honest. Again, because it doesn't really match up. If 57 to 70% of respondents are saying, hey, no, it's fairly priced, and why isn't everybody buying? That would indicate that bid-ask spread should be a little tighter, but in reality, it's a little bit further away.
79% of individuals that are looking to buy high-income apartments think they're fairly priced or underpriced.
Yeah.
It seems almost inverse. Maybe not that severe, but
I would agree. It's fascinating. I wonder if it's the context of people that respond to that question of like, yeah, it's not, the pricing's fine. Like, we're not buyers right now, but I don't know. there's just something doesn't sit too well, or doesn't make a ton of sense. There will be talking about supply in this PwC report as well, noting what we've talked about with the Sun Belt, relative to the Northeast and Midwest markets. There's a quote, with these varying dynamics, rent growth may be slow to return to the Sun Belt markets as they absorb excess deliveries over the last few years, while rents could continue to grow in the Northeastern and Midwest markets where new units will be in short supply. And that's further confirmed in our Midwest multifamily forecast report that we just talked about. Demand is something it's been positive. In fact, the demand story has surprised a lot of folks. There's been a lot of supply, but demand has outpaced supply. It doesn't necessarily mean that there's been a ton of rent growth. It's just that the people have been moving into these apartments. It's because the landlords have lowered the rent, given concessions to get people to move in. But as supply recedes, we're also going to see demand recede. And this isn't shocking, though, just because there always is a little bit of a build it and then they come cause and effect of, like, there's new supply. It does kind of generate some demand of, I'm going to move into the new thing. But then that kind of trickles down. And I think it was probably kind of a false prediction to say, hey, we're going to see this demand stay elevated at multi-decade highs as supply recedes down to kind of a more normal level. Typically, they kind of move in somewhat lockstep. It's just when they'll get a little bit out of pace with each other, which creates some of those inflection points. Affordability is in a just continuing trend. It's just more and more in the national conversation of affordability, and specifically housing affordability of, how do we solve for this? Talked to Addison about this on the last episode last week. And, there was a lot of discussion over the 50-year mortgage that's been proposed. Do you have any opinions on the 50-year mortgage, Griffin, by the way?
I'm comfortably positioned with my mortgage in my home, so I haven't really read too much into it. But it does seem like a little bit of a smokescreen in regards to lowering monthly payments, but then the overall interest expense at the end of that 50 years is, astronomical. So the lenders are positioning themselves to continue to make more money while kind of pulling the wool over the homeowners' eyes in regards to, in reality, lowering their monthly payment, but on the back end, they're actually going to be spending, multiple more in regards to their interest payments.
Maybe about like a third more.
And then name somebody that that's lived in their house for 50 years.
Yeah, but not too many people. Now, I think that's where I think some of the confusion kind of stems from, is that, like, to your point, who lives in a home for 30 years? You get a 30-year mortgage today.
You don't have to.
Who's saying, well, you're gonna pay so much in interest over your 30-year term? But you could say the same thing about a 15-year mortgage. Mortgage has the advantage of the 15-year mortgage. It's cheaper because, relative to how much interest you're going to pay.
Right.
But most people aren't solving for total interest paid, relative to building up equity. They're looking at what is my monthly payment going to be for cash flow. Kind of the same way we look at multifamily. I mean, we buy multifamily and we use interest only terms. So we typically have multiple years of where we're not paying off the debt at all. We're just paying interest because we're looking at cash flow. How much cash flow are we going to be able to throw off from the asset? And then we're looking at, forcing appreciation through, increasing the rents, or rents going up over time, increasing the asset value. And so the valuation is going to grow, in a faster than, we're just going to be paying the debt off. So, like, we're not betting on, we're just going to buy this thing and pay the debt off over time, and it's more of, we're buying it for an investment purpose. It's going to generate cash flow. And so the 50-year mortgage, you can think of in a similar way of, if your plan is, I'm going to live here forever, then it might not be if it allows you to get into the home and it's the only way you can afford it, maybe that's fine. There's just going to be a higher interest expense over time. Yeah. But if you're buying it from, for cash flow as an investment property, maybe it makes sense. I mean, amortizing over, 20 more years versus 30. Yeah. But I think the biggest issue is, again, are we really solving any problems with it. It's like it's another like loan product for like the banks to sell, but like you're not solving affordability with a 50-year mortgage.
No.
Like it's like very marginal fractions of a percent of people you might be able to help.
Yeah.
And so we're not really getting to the core. One piece I want to talk about from the PwC report, it gets back to the Midwest and affordability. And this is from a researcher at a multifamily real estate trust, probably located on the coast somewhere. It's a quote, "A trend we expect in the next few years is that people will be looking for fringe markets that are more affordable," said a researcher at a multifamily real estate investment trust. "Places like Columbus and Indianapolis are not exciting for investors, but they are driving decisions for households." Well, he obviously is not a subscriber of the Gray Report, because there are investors that are excited for markets like Columbus and Indianapolis. In fact, they're like kind of our two primary markets, exactly for reasons like this, because folks that are sitting in some ivory tower working at their fancy real estate investment trust have that opinion of calling places like Columbus and Indianapolis a fringe market. But the reality is it's true. Folks are looking for affordability. And I don't know if you listened to this last week's All In podcast, but they're talking a lot about how, I think they were talking maybe like a Ben Shapiro quote, but this concept of historically, folks have moved to areas that have higher potential for better outcomes. You're living in the old country in Europe and there's no opportunities, so you come to America and search for opportunities.
Right.
You move out of the country to the big city for opportunities. You move out of the big unaffordable city to the fringe Midwestern market on the frontier to find opportunities. It's like the story of America to travel for opportunities.
Right.
And there's this mindset though that we are all entitled to live where we were born in the same way, and that I should be able to live here because I was born here, regardless of maybe you were born in Manhattan or in Orange County, California, and it's just really expensive to live there.
Right.
And maybe your parents worked really hard to be able to live there, but does that entitle you to be able to live there for forever?
Yeah.
Also, and the reaction is, I'm going to get the government to make prices more affordable because I have some right to live in this specific geographic location.
There's a paragraph, I think, just below the quote that you read, and I think it is discussing just that of affordability is prompting growth in outer suburbs or satellite cities nearest the largest metro areas. And I think that we're seeing that in Indianapolis, some of the cities that are listed there, Fort Collins for Denver, Ocala for what would be Orlando. We're seeing that in Greenwood, Fishers.
Greenwood's a good example.
Greenwood's a great example.
Because I think people are even looking to move to Indianapolis, and they first look at Carmel because it's ranked as one of the best places to live in the United States.
Yeah,
great schools, but then they're like, "Dang, it's expensive to live up here in the northern suburbs, just north of Indianapolis. Where else is a good submarket? Oh, the south side suburbs have good schools, good housing stock, but it's more affordable,
and you're obtaining all of, if not very similar opportunities." For forward progress for your family, living in and around Indianapolis, in what is a safe, affordable suburb.
Yeah, makes a lot of sense. Last piece before we move on to the Yardi Matrix report: investors are bullish, but they're wary of risk, and this resonated with me, similar to that kind of the earlier quote of, "Hey, look, the fundamentals make sense. All feelings in our gut say this is a good time to start buying multifamily," but the yields just aren't there on every deal. Most of the deals we underwrite, just the returns just don't look good, and sometimes they're really far off. I mean, we're going to have done one deal this year. We wanted to do like 3 or 4 deals this year.
Yeah.
So it's it says here, while 2026 could be the year to break the logjam on transaction activity that has stalled since interest rates jumped in 2022, that is no sure bet. Much depends on the direction of the 10-year Treasury yield. Quote, "If rates drop substantially to 4% or lower, we could see a dramatic increase in activity as cap rates recalibrate," to the head of a national brokerage. investors are ready to go. I mean, we had some lenders in here in the office just a second ago, and they said, "Man, those rates, the 10-year Treasury dips below 4%. It's buy, 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 buy. Everybody's ready to go." All of a sudden, the deals start penciling, but we're kind of waffling. 10-year really hasn't dipped below 4% much. A lot of folks are having to use shorter term debt. We did a 5-year Freddie Mac deal on our latest transaction because like that's right in the belly of the yield curve. So like the 5-year rate is a little bit lower, the spreads were a little bit better, but then you have to deal with these pesky things called these exit tests that the agencies are doing that are complete black box. They don't tell you what the test is, but you have to pass it, and maybe the criteria that we're judging the test may change in the middle of
Maybe
it.
it changes.
So it's risky to do deals right now. Just the ability to transact, and again, if you can't underwrite much rent growth, you're either just you're left with using intuition or finding a really niche submarket where you can get some rent growth, like we found in Greenwood.